Wow. I had no idea.
It's tax-free money. Why wouldn't you take advantage of it?
And thinking, oh my God, that's a lot of money. And now it's hilarious. All right. So, welcome, Amanda Pivar, mortgage specialist. And of course, Charlene Williams, who's, my co-host. We're going to be talking about a few things today, obviously, about the sandwich generation. But three things we kind of want to hint on today are sort of an understanding of pre-approvals and pre-qualifications in the process, creative financing options, and mortgage renewals, because that's one of the things that I think people know is coming up, and very rarely do I think they understand the ins and outs and what that sort of entails. So those are the three things we were hoping we can kind of pick your brain
Perfect.
today on, Amanda, if we could.
Absolutely. I'm here to answer your questions. Those are definitely the three hot topics in mortgage world right now.
Yeah.
Well, I mean, let's just say there's more than three. I can think of two more, but we won't even go there.
True.
That for another episode.
Another episode, interest rates, that sort of thing. But
Yeah.
I think that one is being beaten to death. So if we don't cover that, we're good.
Okay.
Yeah. And we're so close to the next Bank of Canada. It's too early to talk about it anyway.
Exactly.
Yeah. So if you wanted to just take a quick moment, Amanda, maybe tell us and the audience just a little bit about yourself, what you specialize in, what you do.
Perfect.
Take it away.
Thanks, Greg. So my name is Amanda Pivar, and I am a mortgage broker with Mortgage Connection, which is a part of the DLC brand. I have been a mortgage agent for over 12 years now, so I really started to learn the ins and outs of everything mortgages. I started doing a whole lot of first-time home buyers, still do a lot of first-time home buyers, but now I've seen my clients into some of their second and even third homes and starting their investment profile. And I'm excited to be here with you and share some of my knowledge.
Awesome. Thank you very much for being here. So sort of what we aim to do with, the Smart Money sort of brand and the services is really just to give people a sense of exactly what you're talking about, like tools in terms of building wealth through real estate, through smart financing, through making educated decisions where they previously maybe wouldn't have thought of these things.
Yes. But we weren't taught in school.
No, unfortunately. And it was a good question. Like, why do you think that is? I feel like this is like such a weird learning curve as an adult to just take on these things. And just when you think you have a grasp of them, as we get, you buy your first home, you get married, you have kids, that alone is a challenge. And then you get to sort of middle-aged and beyond, and then your parents start needing more help and assistance. And then your kids go to university, then they need more help and assistance. I would have thought like 10 years ago, the 10-year ago me would have thought this would have been almost like being on cruise control. You know what I mean? Like I've
Right.
made the big decisions, I've done the things. From now on, it's just managing the process. And it's actually, I will just only speak from my own perspective, but I find it infinitely harder now,
Yes.
especially post COVID, to get all of the things needed to service the generation above me and the generation below me, and hopefully take care of my own needs as I get older. It's blinding how many things you have to go in search of. And I'm glad you're here because you're one more thing I can tick off the box.
Yeah. It's so interesting that back when we were all in school, they didn't teach financing, but I am happy to say that a lot of schools have now added a course on financing. There's also charities and companies out there, like one of them, Enriched Academy, that saw the need to educate the younger generation on how does a credit card work? How do you get a mortgage? What's a loan? Things like that. They just didn't teach us at school, and they're now starting to. And I think it's a lot of people have this wave of in your early 20s, you get in credit card debt, then you pay it off. Then you have bad credit habits that people don't realize actually affect your ability to buy a house down the road. And these are definitely things that, the younger generation and even our generation needs to be educated on because they don't realize credit mistakes in your 20s affect your financial future goals in your 30s, 40s, and 50s.
Yeah. And I think just to touch on that, like as those small mistakes sort of mount and create big problems, I think if you flip that on its head and say, okay, but if you make small adjustments that are positive, those compound into really big, things that can propel you forward, can give you financial stability, can help you, save for a rainy day. Like it just,
Yeah.
I wish I had listened more as like an 18, 20-year old when old people spoke about all the things they spoke about and I just didn't listen and bought a car,
I
right?
think,
Like I
yeah.
would be so much farther ahead if I did the simple things, whatever it was, the late 80s. Like my life would be radically different today.
Yeah. Even budgeting. Like if I think if more people knew how to properly budget themselves in their early 20s when they graduate school, that will set them up for the future because that's when people get in trouble. They now have a credit card, they're making money for the first time, but they don't really know how taxes work. They don't know how much is going to come off. They don't realize the cost of living and how expensive it is and how it actually goes up quite a bit every year recently. So I
Mhm.
think even if people knew the simple foundations of how to budget yourself correctly, when you do get your first job, that would go a long way with setting people up for the future.
Absolutely. I like how Greg referred to old people when he was in his 20s.
But they were people that we couldn't identify with. And we're talking like pre-internet. So it wasn't like you
Right.
could just get information. You actually had to listen to someone or physically walk to a library, pick up a book, and by the
Yep.
like it seems archaic now, but you got to put yourself back in that position to get information. You either grab like a business magazine, like
Hmm.
Forbes or something, and you read it and thought you were smart. But if you went to get a book, it was like The Wealthy Barber or something along those lines.
Dad, poor
And
dad. Yep.
yeah, and again, it's like it was so hard to extrapolate the information as a young person and apply it to yourself. It just seemed like one day, like this could be a really great idea to implement, but you never really got around to it, as opposed to today, where you can actually see and speak to people that are doing the very thing you want to do. You can join groups, you can go to meetups, there are investment clubs, there are people like you
Yeah.
that we can do, video calls with and just ask the question, be like, please help me. That didn't
Exactly.
exist 30 years ago. Like
Yeah.
it was just
Yeah.
fly by the seat of your pants. And then if you sort of missed that boat for a period of time, it, like you said, it became a habit and you're just like, oh, well.
I'll catch up
And
eventually.
yeah,
Yep.
so. So I guess one of the big things, the big targets for people nowadays, obviously, is home ownership, right? Which is perfectly suited to, you being here today, being, a mortgage specialist. Um, One of the first things we want to talk about is the pre-approval versus the pre-qualification, because I have seen that in the last little while where people will send me, oh, I'm pre-approved and send a letter and all the rest of it, but clearly there are pieces in between that they're missing. Could you give us a little?
Yes. So the pre-qualification of everything. So pre-qualification basically means that lenders are looking at your income, your down payment, and they're doing a rough estimate of what you can afford. They're not checking credit, which is such a huge aspect of getting a mortgage pre-approval because the amount of time, and actually comes back to what we were just talking about, the amount of time that I have checked someone's credit and they have a old bell debt from an apartment from 10 years ago they didn't realize they had, and it now is a couple $1,000s they owe. Things like that pop up that have to be cleared that actually stop you from getting a house. So pre-qualification is really just a general rough estimate of what you can afford, but definitely not something you actually want to start shopping for a property using. So pre-approval is when we do a full application. We run your credit, we look at your documentation, and somebody takes a deep dive into your financial situation to figure out your max affordability so that when you are shopping for a property, you're shopping with confidence. During that pre-approval, it also gives an opportunity to maybe work on things, whether it be you need to pay down some debt, or if you had an extra 5,000 for a down payment, how could that change it? Do you maybe have some help from mom and dad? These are more in-depth conversations we're having so that you are maximizing your affordability and being successful when you do go to make that first offer.
Awesome. And so typically, like, how long does a pre-approval last? Because I have seen some sort of range in length. Typically, what are people, once you've got that budget to shop with, what are people usually given in
Yeah.
terms of a time frame?
So lenders, except for one, BMO, they do 130, but everybody else is 120 days. Now, that's not to say that if it's taking a client 150, 160, that we're automatically rechecking their credit, because some people it takes up to a year to find that perfect property. And we're checking their credit every 120 days. That's ding against their credit score. And that's something the last thing we want. So we always put our clients when we're starting to hit that 120. Here's a list of things that if they change or if you do, we need to know. Like if you end up getting a car payment, if you've quit your job, if you have more down payment, let's rerun these numbers and figure out how it changes. But 120 days is what the credit bureau and everything is valid for.
And does that 120 days, is that basically from the time they're approved to the time they come to an agreement on that offer, or does it also have to fall in line with, say, closing?
Yes, has to fall in line with their closing date. So if their closing date is 100 and let's call it 40 days, they're subject to new interest rates and a new qualification.
Gotcha. Cool. And in terms of being competitive in this sort of market, I know I have been presented with, people coming forward. So me being on the listing side, buyer agent is, being very forthright with this information, saying that my clients are pre-approved and even offering to provide proof thereof, of their qualification. Obviously, on our end, on the receiving end, it does give clarity and give confidence. Is there any pros and cons from your perspective on, having that information, utilizing that as a buyer or a seller?
Yeah. So one of the things I do is, well, as a buyer, there's a client and a buyer right now. The last thing you want to do is tell the selling agent what your max affordability is. Most of these pre-approval letters talk about what your max is. So what I actually do for my clients, with of course permission from their buying agent and the client, is email the listing agent and just say, want to let you know I have a client offering with this agent on your property. Their financing is in order and they have been approved to make an offer on this. That way, I'm not giving away anyone's cards and they're able to be negotiating and competitive on their offer, but still give the listing agent the peace of mind that they actually do have their financing in order and they're not wasting anyone's time. Another thing that I actually have access to, but not everybody does, is we do have a lender who will let us do pre-appraisals. This is huge right now in a market when appraisals are coming in lower. So when a client is sending me a listing that they're interested in offering on and their max purchase price, we're actually running it through a system that either comes back as a pass or a fail to really have buyer confidence in that property, knowing that financing won't be an issue.
And that's a good point. Like in terms of properties not appraising at that level, what would people face? Let's say there's a shortfall. You offer or you agree to 1 million. The appraiser comes back at say 950.
You're responsible for that. And right now, unfortunately, we're seeing this a lot with condos and pre-construction condos that people had purchased years ago that are now closing and they're coming in not 10, 20,000, it's 150, $200,000 appraisal less than what they had seen paid for that property. So you are actually on the hook if you do not have a finance condition and you're already for an agreement to come up with that difference.
Wow. And so just to be clear then, so let's say you had a pre-construction purchase of 600,000 years ago, market changes, and now that unit is appraised at 450. That $150,000 shortfall. So the bank is still going to give you a mortgage, but only up to 450.
That's correct. They are using that new purchase price or that new appraised value, apologies, as their benchmark, and you need to come up with that difference.
Wow.
I have a question on that, Amanda. I've been hearing something about blanket mortgages for these pre-construction condos that people purchased, let's say 4 or 5 years ago. They're now coming to occupancy, that sort of thing. I've heard about this where banks are giving blanket mortgage. Is
Mhm.
that a thing? And I mean, I understand the reason why they would do it, but there are definite negative um uh, throwbacks from that. So,
Yeah.
is it a thing?
Yes. So some people are getting lucky that depending on who the developer's bank is for financing, they're in a situation right now, a lot of these banks, that developers are going to start defaulting if people cannot close on their properties, which is happening. So they are just going in, they're closing their eyes, they're not appraising, and they are financing. And that is just so they can get their very large chunk of money out of the situation and have smaller independent. The risk level is a lot lower doing that. Chances are, if you do that for 100 units, maybe one, maybe two might default, but that's a lot less money than 30, 40 million, the builder.
Ah, okay.
But it's not happening with all buildings, but it is happening with some.
Okay.
Hmm.
That's good to know.
Scary.
Scary, eh?
So in terms of mortgage renewals and refinancing, maybe we can just do a general sort of overview on that, if you could, just to help us or help our audience sort of better understand what that looks like, because people typically don't revisit this, like once in 5 years kind of thing.
Yes, and they're leaving it too long. So I find a lot of people are leaving their wills last minute. Realistically, you should be starting this conversation with your mortgage professional at least 6 months in advance. You're not going to be locking any rates in at that time, but you're starting the conversation. And when I had the conversation with clients, it's things to think of over the next 2 months because 120 days to maybe start the process. What's your 3 to 5 year plan? Are you thinking of moving? Should we look at a mortgage that's portable in case you do move? If you are thinking of moving, do you have your deposit, or should we be looking at a mortgage with a line of credit to access your equity sooner rather than later? Investing. Do you have any plans to invest in real estate that line of credit could be useful for? So things like this, people don't really think about until it gets brought to their attention, and having a 2 month period gives them time to think. Some scenarios, maybe do some research. So I always say to people, don't wait till last minute. Start it at least 6 months in advance and open that conversation, because things might spark your interest that you didn't know existed. 120 days prior to is when we can lock in the interest rate. The nice thing about people who are starting early is it gives them wiggle room. If the rates go up, which we unfortunately are in a bit of a rate increasing environment right now, you're locking in today's rates, not the month prior to renewal rates. But if the rates go down between now and then, you will have the luxury of being able to keep dropping your rate, but at least you're secure. So, biggest advice, start the conversation early and don't leave it to last minute when you can officially lock in a rate.
Okay. And so just let me just run a scenario by you. Let's say the mortgage is coming due April of 2026, and they're going through the process, and after they've renewed a year in, they decide, I think I'm going to sell.
Okay.
So maybe they're leaving the country or downsizing or relationship breakdown, whatever the situation is. What typically happens in that situation?
Yeah. So if let's just start with they're leaving the country. Usually people know if they're having thoughts of that. So that's when we would put them in either a variable rate mortgage or maybe just a line of credit if it's a temporary thing. The reason we would do a line of credit is just there's no penalties to break it at the time of. If they're kind of unsure what could happen, we do the variable. And the reason why is that's always going to be 3 months interest to break. This year alone, we saw penalties with the bank from the fixed rate mortgages go from 3 months interest up to interest rate differential, which basically increase penalties by about 4 times. So we always want to stay flexible based on people's plans. Now, marriage breakdown's a hard one because you can't always predict that one. If one spouse, though, is moving to another property, we can actually bring that mortgage with them so that they avoid paying.
Gotcha.
Hmm.
Well, all it takes is one Coldplay concert, and
That's true. And the whole world knows.
Oh, that is
I had to
cold,
squeeze that
Greg.
in.
That
Sorry,
is cold.
it fit beautifully. Okay, so creative financing options. So these are some things that are really of interest to people that are in our circle. What are some low down payment options? So there are people who could be in our situation where you're between elderly parents, younger kids
Mhm.
have a few dollars somewhere. So you've got 100, 200, $300,000 somewhere that you may need to put to work to help, either have multi-generational living or help a child sort of get started. What are some sort of creative things that you're seeing out there that people are doing or are possible?
A lot of family help, a lot of gifted down payment. There was this idea that came out recently, and it was something like 47% of first-time home buyers are now actually getting help from the bank of mom and dad or grandparents because it's the easiest way of being able to get your child into the market. What I'm also seeing a lot of parents doing is gifting, but with a catch. They're taking some of the ownership of that property as a return on their investment when their child goes to sell. I think it's no secret right now that our condo market is down, and it's an awesome opportunity for investors and first-time homebuyers to get in. Not every parent wants to invest and become a landlord, but they have money available. Their thought process is, let me lend my child this funds, and when they go to sell it, take a small portion for the funds that I have lent them. Because let's face it, the market will turn around. It's supply and demand. When builders are cutting their buildings and not building anymore, we're going to run into a supply and demand issue down the road. So the biggest thing I'm seeing right now is a lot of gifted down payment. The second thing I'm seeing a lot of is people taking advantage of the new down payment rule. So a lot of people don't know that come this year, the Bank of Canada, sorry, not Bank of Canada, CMHC increased the top of what they're able to purchase and get a CMHC insured mortgage. For 12 years before this year, you were capped at 999,000. This year, you're now able to purchase up to 1.5 with a CMHC insured mortgage. And instead of having a down payment of 300,000, it's 125 that you need. And I'm surprised how many people are taking advantage of it and not necessarily first time buyers, the move up buyers. I've seen a lot of clients take a small hit on selling properties just to get that equity out to buy more of a forever home while using that program.
Yeah. One of the things, I don't know, maybe you can give me some input. One of the things that has always bothered me, because I've been in, I guess we're going on 18, 19 years, is that the CMHC rule, like you said, hasn't budged, but the property values clearly have.
Yep.
And like, it's in your mind, is there a reason why they waited so long to move from like 1 million to 1.5 million? I feel like in that time frame and in that financial gap, I think there were a lot of people who were sort of lost or put into a position where maybe they were too risky and didn't have backing of something like a CMHC.
Think it took younger generation coming in. Unfortunately, a lot of these organizations have the same people who are at the top that make these decisions and approve it for years and years and years. And it's old school thinking and mentality. And so we have something called MPC, it's the Mortgage Professionals of Canada, and they have a board of directors. And they've been lobbying for years to try to get some of these rules changed with showing data, proof, and things like that to help strengthen their case that even if you do this, people are not going to increase their default rates. And it finally worked and people listened. And I think newer people coming to roles definitely help that as well.
Thank you to the younger generation.
Yeah. And I think
That's
also,
you.
yeah, I think one other big thing too is default rates are pretty low. So if you look over the last 20 years, default rates for mortgages have actually been going down, not going up at all. So I think that gave them also more security that people, yes, are spending more than ever on properties, but they're not defaulting like people were back in the 80s and 90s. So I think that also helped them.
Well, I want to underline that point because I hear that not a lot, but often by
Mhm.
people who are outside of the industry talking about, these young people are going to, and they list all the negatives and, lose their house and lose their job and all these other sorts of things. It's nice to actually hear someone from your perspective actually give us the real data that that is not actually the trend and the case.
Yeah, and we
Um,
just thought after COVID too, that would have been the
yeah,
time that people were defaulting and default rates were very low.
no. I mean, and I guess you can speak to this as well, Charlene. Like the people that I saw that during shortly after COVID. I would say not immediately, but maybe like
Mhm.
12 months after COVID hit. That is when I saw people who were either in terms of job loss, relationship breakdown, financial pressures,
Mhm.
they sort of sort of showed themselves and identified themselves at that point, but I didn't see anyone really default. I saw them selling, liquidating properties, moving assets around, like you said,
Yeah.
getting sort of multi-generational living, going back to mom and dad and saying, hey, how can we fix this? I didn't see anybody compared to, the horror stories of like, hate to bring it up, but like the US,
Yeah.
where, things are getting repossessed and houses being foreclosed. And I didn't see that.
Yeah.
Um,
And I
and
think sorry, I didn't cut you up. I think
oh, go
one thing
ahead.
that's really helps with that in that the US doesn't have a stress test. I know when it
Mm,
came in, and we all were like, this is horrible. I don't know why they're doing it, but it worked because now we have a CMHC up to 1.5 million. People are not defaulting on their home. Realistically, they're looking at payments and being qualified on much higher than they are. So when we did see our rates increase, we didn't see the big, we got to sell our home. We saw people adjust. Yes,
yeah.
restaurants are probably suffering because that's what people are going to do first. They're going to cut out the fun spending. They're not going to move their child from their school.
And I just to be clear, the defaults that are happening now and the expected defaults that are again expected because the interest rate is higher now. I've heard of something like 36, 38% over the next 6 months to a year. Default mortgages are going to go up.
Mm-mm.
I don't know whether that is true or not, but I have to believe that the stress test, even though we all hated it, because even as realtors, we hated it, it
Yeah.
had to have some sort of positive effect
Mhm.
on people when the interest rates started going up like 3 years ago, right?
You're absolutely correct, Charlene. The stress test 5 years ago, we were stress testing people on 5.25%. Rates are not at 5.25. They're actually a lot lower. So yes, people might be going from a lovely 2% right now up to somewhere in the mid fours. They were stress tested on 5.25. They can afford it. It's just lifestyle changes. So I
Yeah.
don't think we're going to see this big default that people are expecting. Where we are seeing defaults are people who unfortunately fraudulent files. I think a lot of fraud has come to light over the last couple of years within the industry because of those who are defaulting, not the people whose parents gave them help or co-signed. It's people who maybe did something they shouldn't have took out that mortgage.
Mm.
Yes, and that is another show entirely.
And that is, oh my gosh,
Yeah, we don't deal with those kinds of people.
No.
I'm
But
not.
in fairness, I would say as well that like a lot of these sort of career fraudsters, I
Mhm.
know they put a lot of onus on our industry and obviously your industry as well, Amanda, to sort of um, crack down and alert, any sort of weird, fraudulent type behavior. But one of the problems I do have with that is that obviously, if you're a career fraudster, you're already well equipped to know
Yes.
these systems in and out.
Yeah.
And when you've got 80,000 agents just across Toronto, it doesn't take much to find a weak link in the chain and exploit it,
Yeah.
right? And I think, at that point, then that person obviously becomes the rotten apple, and
Yeah.
rules must change, and everyone else pays the price in terms of insurances and different things
Great.
that need to fix and whatever. Um, I did have a question in terms. You mentioned something a little while back. So one of the things Charlene and I spoke about before was, so like for instance, my daughter's going away to university, so
Yeah.
she's going to be living away from home, going into residence in year one, but years two, three, four, possibly five, will need to house herself. And one of the things that you mentioned, which kind of caught my ear, is the idea of parents helping their kids. So, I mean, if we're going to pay, I don't know, anywhere from 10 to 15,000 per year just for housing and food and all those other things, are you seeing people, and I have heard through other agents and friends, that they're actually looking at sort of pooling their resources with, say, another family and getting, a small condo in London, Ontario or something where they can actually pay themselves in the short term, 3, 4 years, and then figure out is that, a property or an asset that they will keep as an investment and carry this on, or, gift it to the kids or figure out next steps. Is this something that's, is it feasible for the average person with a few dollars of equity somewhere, and what sort of challenges or pros, cons, any sort of light you can shed on something like that?
You have money to be able to buy a student rental for your child to live in there. That is the best thing you can do. You are correct in saying you're spending all this money on rent that you could be just paying yourself. You could also put your child on as an owner of 99% and yourself as 1% so that you're sheltering capital gains when you sell. It's her primary or his primary residence. That's where they're living. So that is such a huge capital gain shelter. So why wouldn't you do it? Also, you have, let's just say you buy a house and you have 4 other roommates, they're paying you as well. That it ends up costing you almost nothing to hold this home because you have the other tenants in the home paying your mortgage down. So put it in your child's name, be on it because you have to because they don't have any income as a co-signer, but let that capital gain shelter go. And then at the end of the 4 years or 5 years, you can choose, do we sell it, take our profit and give our child something to buy their next property? Or do we keep it as investment property? Because when your child then moves out, you can change it to a rental and you only pay capital gains on the day that they move out on the value from that day to the day that you sell it. So I think this is a great idea. We actually own the student rental, and when you have 5 or 6 students in a home, each paying $1,000 a month, it's crazy what they're paying right now. It really helps carry that property.
And so, like, as a parent, you could go down as low as 1% ownership,
Mhm.
and then so it becomes primary residence for your child
Yep.
upon. Wow. Hmm.
Yeah. So
But
when your
that,
child turns, oh, sorry, Julian, I was gonna
no,
say
you go ahead.
one quick thing. When your child turns 18, you get them that credit card, so they start building up their credit history, so that 1 year passes and they go to qualify. They're not really going to look at the child as much as they are the parent because that's basic within the bill for it. But yes, you can put the child on for majority owner to save on that land transfer tax, but then also make it their primary residence.
See, Charlene, that one question has saved us so much.
I don't have any children, Greg.
I mean, we as the global we, like, the
Oh, the global.
audience.
I thought you were talking about me and you.
No.
So no, my question is, if you do it that way, have the parent as the 1% owner, then they don't get to take advantage of the first time buyer rebates, right?
Absolutely.
Oh yeah?
Anytime first time home buyer, the only time you will not qualify as a first time home buyer is if your spouse or common law partner on taxes have purchased a home before, then you no longer get it. But if you co-sign with a parent, not a problem. You're still a first time home buyer.
Oh wow.
Yeah. You just pay full land transfer tax on that 1%. So you're like maybe $100.
Oh, I had no idea. Wow, I learned something, well, many things, but new today.
Good. I'm glad I can help. That's what I'm here for.
Gosh.
You've been
So,
holding out.
any more creative financing options that you could think of off the top of your head, Amanda, that would help us get through this very challenging,
Yeah.
very challenging time in Ontario right now?
So I think one of the biggest things is people don't realize how little down payment you actually need to get into a property.
Please tell us how little.
You can put down as little as 5%. And for the first time in a long time, you can actually buy a condo in Toronto for $500,000 and less and put down for $500,000, $25,000 to get in your property and pull it from your RRSP. I feel like people forget sometimes that when you're a first time home buyer or classified as a first time home buyer, so you haven't owned a home in the last 4 calendar years, then you can pull from your RRSP. It's tax free money. Why wouldn't you take advantage of it? And then you have 15 years to repay it. So anyone who is sitting in a rental property right now and has at least 25,000 on their RRSP, now is your opportunity to be getting into the condo market and starting to pay yourself versus a landlord.
Wow. I had no idea. So, okay, I'm gonna ask you this question. You may not be able to answer it.
Okay.
So, and 25,000 down,
Hmm.
let's say you're purchasing 450.
Okay.
That is doing the quick math because it has to be 425,000, right? Not
Hmm.
including, we're not going with land transfer tax and all the other things that we need to worry about, but just bare bones to bare bones. You have to be able to qualify for $425,000.
Yep.
What kind of income would you need in order to qualify for that?
So this is going to be a very rough number because we also
Rough,
have to take in
rough,
consideration condo fees, property taxes,
right.
but roughly 75 to 80,000 you would need to qualify.
Darn, that's pretty good.
Yeah, it's definitely not bad right now. And but also a lot of people have to remember too is it's actually easier to qualify for a condo now than it was last year because part of the CMHC change was for a first time home buyer 30-year amortization. So before we could cap it at 25 years, now we can cap it at 30. So it's less income than you needed before. My number's probably a little bit off because I'm still getting used to running numbers with the 30.
Which
It's
is
probably a little
fine.
bit lower.
Okay, so what kind of mortgage would we be looking at for that? Sorry, I'm taking over here because I find this to be absolutely fascinating and it will help the viewers because we are talking about smart money here.
Absolutely. So I'm going to give you a very rough estimate.
Rough number, rough.
And I actually ran a number for a purchase price or for a mortgage of 525 yesterday. So it's I roughly know it's around $2,200 a month for your payment.
Your mortgage payment, 2,200 a month,
Rough. Yes.
rough.
Yes.
And if you have a condo that you can get, I don't know, the maintenance fee is below 500,000, you're looking at 2,700 for a one bed, one bath condo in the city
Mhm.
that you could afford to purchase.
That's correct. And a lot of people will say to me, well, that's actually more than I'm paying for rent, but they're not thinking about part of that's actually going towards principal. So, yes, you might not see it right away, but you're saving up for your future by paying that condo down and building equity.
You're building equity. You're building equity. That was the thing that I was going to say. Plus, we know from sitting in our position where we are now, in 5 years, there will be a boom on condos
Yes.
because there are no new bills.
Hmm. That is correct. So, if anyone's sitting there and thinking, like, just debating, it doesn't hurt to run your numbers because you might actually be shocked. Because I think even having this conversation, really, $2,200, 2,200 surprised you. And I think a lot of people would also feel the same way if they just called their mortgage professional and got their pre-approval done to run the numbers.
So, to those of us or those of them who say they're not ready, I'm not ready, I'm not ready,
Is anyone ready ever? Like some of the biggest decisions in life.
right?
And I always say to my clients too, especially first time home buyers, it's yeah, it's definitely scary. It'd be weird if you weren't a little scared. But I have never had a first time home buyer come back to me and say, "Oh my gosh, what did I do?" It just becomes your new norm. Within
Yeah,
the first month or two, you're used to it, you've adjusted
adjust.
accordingly, and you're fine. And also like what I also found when I bought my first property, I was more excited to have people over for dinner versus going out. And little things like that just make the property very affordable and work with your lifestyle.
Exactly. I felt the same way with my
Yeah,
first property. So, and it was pride of ownership for me,
right. Pride of
right?
ownership for sure. And a lot of these condo buildings nowadays, why would you leave? They have pools, they got
Right.
pool tables,
Yeah.
everything you need.
Yep.
Yeah.
Everything.
Even your gym membership. People aren't thinking, well, if I buy, I can give up my $100 a month gym membership because I have one in the building. And
Yeah,
a lot of these condo buildings, the gym is social.
Yeah.
I agree. I definitely agree.
And I think one of the things that a lot of the young people sort of miss, or just anyone that's sort of in that rental cycle, that rental trap,
Mhm.
is like you said, I pay less in rent than I would if I followed Amanda's advice and got that mortgage. But I think where they have a misstep is like out of the gates, I think for, year one, two, maybe year three, they have a point. But, and you can speak to the math here. For 5 years, that number that you pay out as mortgage holds. Now, it may go up slightly or it may come down, but it was relatively stable even in the long term, to the point where your rental rates are always trending up. It's only, I think, this last 12, 16 months where we've seen it dip down, but theoretically that will come up again and it will relatively quickly surpass your mortgage. And especially if you're holding for, say, 10 years or 15 years, like you're going to look back. I look back now at like what my mortgage is versus what it started out as, and when we first bought, and thinking, oh my god, that's a lot of money, and now it's hilarious. Now I think it would equate to a young person's car payment.
No,
Like, it's
it's
that drastic. I'm like, people buy cars at that level.
Yeah.
This is a whole house. And if I had to rent my house today, I'd be like, no,
Hmm.
absolutely not. I'm moving to Sarnia or somewhere
yeah,
really far, because I would just not be willing to part with that much money. And it's not a long period of time. Like this, we joke, Charlene and I, like, home ownership is the simplest but most effective investment I think we can ever make. Like,
very true.
people with no knowledge can just listen to people like you for a few minutes, follow, proven advice, and just go about their business and live and take care of their property. And
Mhm.
it's easy.
You look at Barbara from Dragonstead, and she did an interview recently. She said she's never sold a property. And hearing that, I wish I had heard that when I bought my first condo and sold my first condo, because you're right. The prices you pay then versus now, and the rents have gone up. You're, and look at how well she's done. Like, I feel like if we all take that advice, just getting into the market, can't go wrong.
I agree with that. I should have never have sold that property.
Same, same.
Oh,
I'm the opposite. I'm not a fan of being a landlord, but I am a big fan of like primary residence. And so moving up in my own house is easier for me, just because I guess I'm lazy, but I also like the simplicity of not having my phone ring off the hook, Sunday night, oh, something's leaking, like that. That to me would just put me over the edge. I deal with enough client stories and to have
Right.
my own. But one question I do have for you, Amanda, is a lot of people in our sort of generation are now trying to deal with care costs for parents. Before I let you go, is there anything that you could suggest for people who have a home, they have equity, they've got, older parents, they've got perhaps even multiple properties. So a parent has a home, sell or keep or home care. What are people doing in order to free up capital and equity
Mhm.
for, an elderly parent that's maybe house rich but cash poor?
Yeah, reverse mortgages. We're doing a ton of reverse mortgages all of a sudden because it gives people access to their equity in their home without having to sell it. A lot of people are in that scenario where their home has gone up so much, investments are not there, and they just need something to help them get by. And it's usually not very much. A reverse mortgage is a great opportunity. It will either pay out on a yearly basis or on a monthly basis up to a certain percent of your home to be able to help you live and cover those expenses. I think reverse mortgages got a bad rap because of how they were done in the US for a long time. The people lost their home, and that's horrible. But thankfully, we are not the US in finance, and they cap it. There's only a certain percentage that they will allow to go up to reverse mortgage to make sure that it's not going to eat up all of your equity, that when you do sell it or pass it on to a family member, there's still lots there for them.
So this is a product you are seeing more and more of, and it is
More.
something that people should sort of get the negative stigma out of the way and actually explore and dig in before they say yes or no.
Exactly. Do your research on it current day, not previous day.
Awesome. Any other questions, Charlene?
Do you need a mortgage advisor for that? Or to do the reverse mortgage?
Yep. So
Okay.
mortgage professionals, not everyone has their course. I have my course, so we are able to help clients with that.
All right, cool. No, I got nothing else, Greg.
Do you have anything for us?
Oh, do I have any questions for you guys?
Yeah.
Well, I mean,
Not to put you on the spot.
that's okay. I mean, I don't want to ask about the condo market because we all know how it's doing right now. But
Yeah.
at the same time, maybe people should know a little bit about it because if any first-time home buyers out there watching, the condo market is, well, you guys take it over. You know more than I do about the opportunities available.
Well,
Well,
I
we
did a
we agree.
search the other day, actually yesterday, on 500,000 or less in Toronto proper. So all the E's and the C's and the W's, and I came out with over 300 available condos for sale under 500,000. That is a lot. I didn't do by bedrooms or any other thing than that. I did like one bedroom condos, and that was it. So there are, depending on where in the city that you want to be, there's plenty of opportunities. Some better than others, but again, there's just look at it. Call your um, realtor, your professional realtor. Greg and I would be happy to help. Amanda, if you know anyone that's looking, happy to help.
Absolutely. Don't let this be the missed opportunity, like a lot of people in
Yes.
2017
Yeah,
missed opportunity.
exactly.
Well, it's clearly, I mean, it's clearly for certain segments, this is a buyer's market. And I still find it a little odd that, you know, pre-COVID, they always had, you know, a very clear delineation between buyer's market, seller's market, and they spoke about it. Now I feel as like this is a clear buying opportunity, even like for an end user or
Mhm.
even a novice investor. So someone who just says, you know what, I could get this condo, I can rent it for X. I know rental rates are not perfect, but you know, perfect scenario would be, you know, you have a friend or family member who needs, you know, coming to the city and needs to put a roof over their head for the next couple of years for work or school. This is like the perfect opportunity to sort of tiptoe into that space. And like
Yep.
you said, for, you know, if it's, you know, just over 500 and it's costing you 2,200, I mean, it's kind of a no-brainer, I think.
Yeah, and I think one of the bigger things too that investors forget is, yeah, maybe you have a little bit of a shortfall on that condo every month, but when you go to do your income tax, what a great tax shelter. You can write that property off to be basically a negative income, and that will help lower your income tax. So it's not actually a bad thing if you are a couple $100 in the hole every month because you'll make it up in other ways.
Well, there's also the fact that you can, if you were staying at your parents' place and you were making 80 to 85 grand a year and you had the $25,000 in RRSP, buy a condo and rent it. Stay at your parents' place if that's cheaper for you. You know what I mean? So there's always opportunity there. We have to present it in a way that there is definite opportunity. I know no one really wants to grow up to be a landlord, but you know, it is a thing.
Yep. And it's not that bad once you get used to it.
If you go in with the intention, I think it's fine. I think where a lot of people get caught is, and I do see this with sort of couples. So one person has a condo, another person has a condo, they meet, everything's great. They decide, let's move forward, let's get married, let's build a family, let's, And now it's a matter of, are we moving to one of those two? Are we selling both and purchasing something else? And invariably someone decides, well, maybe we hang on to blank, and no one is absolutely sure what to do, how to do it, when to do it, should they even bother? And I think that's where they get into that sort of trap of thinking, well, since we already have a foot in the door, this could be a relatively easy thing. But if you're not mentally prepared for finding a tenant, doing all the small admin things that are required, being on call to, fix things and point them in the right direction should something happen, or even, if God forbid you get a tenant that's not ideal, and you have a slight challenge, if you're non-confrontational or not, taking control of the situation, I think that's where people sort of get into a bit of a problem. But like you said, if you go in with your eyes wide open, I think you're okay.
Yeah,
Mhm.
I would agree with you on that.
Absolutely. All
Awesome.
right. Are we wrapping, Greg? Are we wrapping?
I think we're wrapping. I think we've picked so much out of Amanda's brain. She's gonna
Oh,
need a nap. She's gonna be
good.
wiped.
Do this all day.
Oh
Yeah.
man.
Happy to come on again as well and share some more mortgage knowledge.
Awesome.
Excellent. Thank you so much, Amanda.
Yeah,
Yeah,
thank you for having me.
this has been great, and your knowledge and expertise has been very, very well received. So thank you very much. And yeah, we would love to have you come back and chat again and find more really random questions to ask you and see if we can throw you off your game.
That's okay. I can handle it.
That's terrific.
Awesome. Thank you very much, guys.